Hi, Tiffany Woodfield here. In this video, we're going to cover the financial planning pitfalls to avoid if you're a U.S. citizen living in Canada. From tax preparation to investing, these are going to be all the things that you need to make sure you have taken care of. And stay to the end to find out my 5 quick tips on how to avoid overpaying your taxes. And if you want more information right away, please go to our website and download the Financial Planning Guide for U.S. citizens living in Canada. As a cross-border financial advisor, my goal is to be able to help clients optimize their investments for Canada and the US. But I've had clients come to me when they've already made so many mistakes that my goal is to try and prevent this before it happens. The first mistake many people make is withdrawing from their IRA and contributing it to an RRSP. Now, why shouldn't you do this? First, an IRA may be considered a superior retirement account. This is because you have more flexibility and options for naming a successor beneficiary. What this means is you can keep the tax-deferred status longer, not just if you're naming your spouse. Let me explain with an example. With an RRSP, when the last surviving spouse or common law partner passes away, all of the RRSP is included in the terminal return. What that means is, say you had $500,000 in your RRSP. It would be like you just earned $500,000 and it would be included on your tax return and push you into the highest marginal tax rate. With an IRA, you have more flexibility. So when the spouse passes away, you could also have named a child or anyone else that you wanted to be able to have that IRA. What that means is they get the benefit of opening an inherited IRA and stretching out that tax liability over 10 years. For example, with that same $500,000, considering currency the same, what would happen is if you had multiple beneficiaries rather than the $500,000 coming into that final tax return, and you had, say, 5 beneficiaries, they would each have $100,000 and they would have up to 10 years to be able to take that money out. So they could stretch out the tax liability on that. As you can see, an IRA offers more flexibility and the potential to have lower graduated tax rates. Now, if you're still considering moving your IRA into an RRSP, one of the things you need to consider is that this is very rarely tax neutral. What I would recommend is that you speak to your cross-border accountant before making any moves. The next big mistake I see people making is contributing to a Roth IRA while they're a Canadian resident. What this does is it actually taints the Roth IRA, and you could be facing Canadian taxation on these funds. When you lose the tax-deferred status as a Canadian resident, this defeats the purpose of your Roth IRA. So remember, when you move to Canada, what you need to do is file a one-time election with the CRA after the year that you file your first tax return. So for example, if you moved here in July, then by April 30th of the following year, you would have to file the one-time election. Your accountant would know about this, and this will help you keep your tax-deferred status. Next, a major mistake people make is inadvertently invest in PFICs. PFIC stands for Passive Foreign Investment Company. What it is it's an investment that creates passive income that's registered outside of the US. I don't recommend any of my US citizens invest in anything that might be considered a PFIC. Commonly, these are Canadian mutual funds, Canadian ETFs, and Canadian money market funds. Investing in PFICs creates a nightmare for US citizens and their accountants. This is because the tax compliance is complex. That means it ends up costing you more for tax preparation and taxes. The way to avoid this is to work with a team who's familiar with what is a PFIC. So build your team of a cross-border accountant and a cross-border financial advisor to make this less of a stress for you. The next mistake many US citizens make when they're living in Canada is to invest with a Canadian-only investment advisor. The reason this is problematic is the Canadian-only investment advisor may not know the complexities that a US person living in Canada faces. So what happens is they may inadvertently invest them in things like Canadian mutual funds, which are considered PFICs. In addition, if you're working with a Canadian-only investment firm, you won't get the full set of tax receipts that you need for Canada and for the US. What happens is then at tax time, your accountant has to spend way more time converting things into US currency and making sure it's correct for both sides. So what I would say to you, it is so important to make sure when you're choosing a cross-border investment firm that they will produce the full set of slips for you for Canada and for the US. Next, you might not have a complete estate plan yet, but one thing to keep in mind is do not have the executor of your will in the US when you're a Canadian resident. The reason for this is the CRA may see this as a foreign trust, which means you'd be at risk of double taxation. The way it's organized is it's not where the assets are located, it's who has control of the assets. So if you have an executor that's living in the US and your assets are even in Canada, it doesn't matter. They have control and therefore it could be seen as a foreign trust. The next major pitfall I see is US citizens leave their taxable, non-registered investment accounts in the US when they move to Canada. The reason this offers complexity is because their accountant now has to track their two different costs. So if you think of it, for the US, it's the original cost that they bought the investment. Now, when you came to Canada, that stepped up to whatever value it was when you came to Canada. So what you do is you need to track and report everything on two different systems. This is why it's important to work with a firm that can produce the full set of tax receipts for the US and for Canada, because it makes your life much easier at accounting time. I've got a few more tips for you, but if you've been watching and thinking you need to get advice right away, please go down to the link below and schedule a call with a Swan Wealth cross-border expert. Before you give up your green card, get advice from a cross-border accountant and a tax lawyer. Just in case you might be considered a covered expatriate, you want to know this ahead of time. Always update your will for the province you live in or state, because each has its own jurisdiction. If you're considering setting up a trust in Canada, be aware that the taxation rules are different for Canada and the US. You're going to want to consult with a tax accountant and a lawyer. When you're a US person working in Canada, be prepared that Canada usually has higher taxes. This means that your salary may bump you into a higher tax bracket, so you want to be prepared for this. When investing in Canada, you want to keep in mind how much money you keep in your pocket when you earn from your investments. There's certain things that will add to your income and may be taxed less favorably, and others that could result in penalties to the IRS. Make sure you know ahead of time. You also are going to want to consider what you're going to invest in if you move back to the US. You want to make sure that this is going to be an easy transition in the future, so I would recommend to work with a cross-border financial advisor and make sure that you leave that door open. Next, if you're planning a move to Canada or you're already living in Canada, go to the link below to schedule a 15-minute call with one of Swan Wealth's experts. Thank you so much, and we'll see you in the next video.